You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. As you listen to News Talk 98.7 WOKI, I have a question to ask. Is the economy booming or is it busting? It actually depends on who you ask. And we seem to be living in a parallel economy where we have some Americans that feel like the economy is even maybe in recession and others not. And we've also got the parallel economy where we get the data for what's really going on with economic growth, with inflation and those things. So we're going to talk about some of that today, and we're going to talk about what that means for you when consumer sentiment is so, in many cases, different than what the data is telling us. And why is that happening? So we'll talk about how to combat that. We'll also talk about the real problem with our soaring debt and our deficit spending. It's starting to really create worry and discussion among bankers, policymakers, and people in Washington even. And then I've got a trick for you, probably the single biggest trick for those of you that are further away from retirement, 15, 20, 30 years. The one biggest trick that you need to know to be able to compound wealth and become financially independent. So that's what we've got in store for you today. Let's start with this idea of, is the economy booming or busting? You know, if we look at the data, it's like we have this one universe where the data is saying one thing, and then we've got a good bit of Americans that believe something different is happening. The official data is fairly buoyant. I mean, economic growth is pretty solid. The job market is strong. Stocks keep hitting record highs. But many Americans think that the economy stinks. The latest gloomy indicator is a Guardian-Harris survey in which 55% of respondents said that they think the economy is shrinking, and 56% think we're in the midst of a recession. Now, if we look at the economic output adjusted for inflation, it grew by a solid 3% during the most recent 12-month period. The unemployment rate is 3.9% and has been under 4% for some time. And the U.S. economy created over 3.5 million jobs in 2023. You know, you cannot have a recession when the economy is growing and employers keep hiring at this kind of a rate. Now, in addition to that, small business sentiment is near recessionary levels. So, you know, we've got this issue with the data saying one thing, that we're in decent shape, and then Americans really don't believe it, over half Americans. So what's going on here? One is there's economic disparity. You know, if you look across different areas of the country, you know, if you get into the more rural areas, they have been hit harder by economic challenges. You know, we look at broad economic data across the entire United States, and of course the Federal Reserve has their regional banks. Atlanta, they have the Nashville Bank, which is part of the Atlanta Bank. You know, and they collect information from all the different regions in the country, but then when that data is released, they're giving us data for the entire country. And then we do have inflation and cost of living. And I actually think this might be the biggest factor. You know, the rising costs of living are a significant factor, in my view, contributing to the negativity that people see. So even though the economy might be growing and inflation might be down, 3.4%. Higher prices for essentials like food, housing, health care, they're squeezing your household budgets. And yeah, you say 3.4%. Well, I mean, that's not too terribly high, but that's coming off a year we had recently where it was over 9%, right? So prices aren't coming down. They've reset, and then they're continuing to go up, and I think most Americans are feeling a squeeze because of the higher prices, and the inflation makes us feel squeezed. There has been some wage stagnation. For many, wages have not kept pace with inflation. Now, some they have, but many they have not, which has led to decreasing purchasing power. And the wage stagnation, despite low unemployment rates, means that more Americans are struggling to make ends meet. And then, official statistics, when we look at the actual job market, the statistics may show a strong job market, but the quality of available jobs is a concern. Many of the jobs being created are low-paying or part-time and lack the stability and benefits that are essential for financial security. And then perception versus reality. In a recent article at Yahoo Finance, the article touched on the psychological aspect of economic perception. And we got media coverage, political discourse, our personal experiences, all those things shape how we perceive the economy, which sometimes leads to a more pessimistic outlook than what the macroeconomic indicators suggest. So we've got this world, and again, I think the inflation and cost of services is the number one factor there. People are squeezed, and so it just doesn't feel like we're on solid ground. Now, I'm not saying we are on the most solid of ground. I mean, I do think the economy is showing signs of slowing down. Inflation has, however, been very sticky. It has been persistent. I think the Fed's going to have a difficult time getting inflation under 3%, maybe even by the end of the year. I think that might be tough. When will it go down? Will it go down under 3%, and when? We just don't know. But certainly by the end of the year, I don't see any significant reduction in inflation, and that's going to make the Fed keep interest rates up, which, to try to get prices down, and then that could lead to some economic challenges. So there are challenges, don't get me wrong. But as an investor, how do you navigate this as an investor? I think there are several key fundamental elements that you've got to understand about investing and growing wealth. One is that your time in the market invested is much more important than your timing of the market. You've heard me say that before, and it is so true. And I'm going to give you an example. Back in the fall, I had several people at the classes I teach that came to me afterwards and said, Jim, if I can get 5.5% on a one-year CD, or whatever the rate was, is in that ballpark, then why would I put money in the stock market? I mean, I don't know that I can make 5.5% over the next 12 months. Why wouldn't I take the 5% guarantee? Well, here's the problem with that. 5%, 5.5%, that is a good guarantee. And we do have an anomaly right now where you can get more on a CD than the inflation rate is. And that's not normal, and I don't expect that to last a long time. But let's say that was you, and you decided to put all your money in a one-year CD. Well, what has happened in the stock market since the end of October? It has skyrocketed. We are at all-time highs, up healthy double digits. Well, see, now if you did that, so if you put your money in the one-year CD and you missed out on the stock market growth over the last, 6-7 months, now you're kind of stuck. Do you sell your CD or wait till it matures and then go back into the market with the market way up? That can be very dangerous. So see, investing in something like a CD for a year is a completely different objective and a completely different goal than what you do when you invest in the market. When you invest in the market, you're investing for long-term growth. And what you get with long-term growth is you get short-term instability and unpredictability. We do not know when the booms are going to happen. A 3-year boom in the stock market. We don't know when the busts are going to happen. We just don't know. But you've got to be in the market. Now, not just in the stock market, but in a very, very diversified portfolio that we've covered in other shows. But you've got to be in the market when we have those significant rallies. We've had a pretty significant rally the last 7 months. So if you're out of that, you missed out. And yeah, 5.5%, 5%, that's a good rate, but you would have made a lot more in the market. So, and now you've missed out on it. So the amount of time that you are in the market is so much more important than timing of the market. And I would caution you to not let your political beliefs have too much of an impact on your investing. You know, we all have different outlooks politically, and, you know, the data would show that politics over time, one president's administration to another, if you look at the data all the way back to George Washington, who's in office doesn't seem to really make a huge difference in the market and in the economy. It's the underlying economic realities really in different presidential terms drive things more than any single thing. So that's just looking at history. Okay, that doesn't mean it's not important, but you know, I've talked about on this show. I mean, during the Trump years, Democrats, as a rule, were not as successful investing because they were scared because of Trump. Under the Biden administration, many Republicans are not as successful because they're scared because of Biden. So I would urge you not to let your political persuasion taint your view too much about investing fundamentals like the amount of time you're in the market. Now, when we come back, I've got 2 more key tips of how to navigate this issue where the economic data is telling us one thing, that we're in pretty good shape, not as good maybe 6 months ago, but pretty good. Yet Americans think that we're not. Consumer sentiment is very poor. Maybe as big of a mismatch between the economic data and consumer sentiment that I've seen in a long time. So when we come back, I've got 2 more tips that you can use to successfully navigate this environment as an investor who's trying to create financial independence. So stay with us. You're listening to More Living with Jim Brogan. This is News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan, and we're talking this morning about, in that first segment, we're talking about this parallel economy where, you know, the data economically is pretty good. Maybe not as good as it was 6 or 8 months ago, but it's pretty strong. And then consumer sentiment, though, is really bad. I mean, over half of Americans in a recent survey that I referenced in that first segment think that we're in a recession, whereas we had 3.1% economic growth over the preceding 12-month period. So, you know, I mentioned the time that you're in the market. I've got a couple of other tips that I think are important to be able to navigate the, let's call it, uncertainty and unpredictability of where we are right now. Because when you have consumer sentiment so off compared to what a lot of the data says, the reality is that's not a great thing moving forward in terms of how that might affect, for example, consumer spending and things like that. So a couple more tips. One is don't ever stop saving and investing if you're working. Now, certainly when you're retired, you're not saving and investing, but when you're working, don't ever stop saving and investing. And I want to bring up one thing in particular. One of the great things about investing systematically, every paycheck, every month, is you actually get to take advantage of market downturns. So think about this. Let's go back to 2022. You know, the stock market, the S&P 500 was down. I think it was a little over 18% in 2022. And the Barclays Bond Index was down 13%. It was the worst 1-2 punch the worst year of the classic 60-40 stock bond mix that we've seen since World War II. So the market was, it was a poor year in the market. Well, so when you look at your nest egg, you're losing money on your nest egg. But while the market was down, if you continued to invest every paycheck or every month, you got to buy in while the market was down. And so then when the market recovered in 2023, you not only recovered the money you already had invested, you made money on the new investment that you added to your nest egg. And that is such a critical factor in investment success and creating wealth. In a market that goes sharply down and then back up, you take advantage of it and you actually come out ahead if you systematically invest during the downturn. So, even if you're in your 50s, let's say you're 7, 8, 10 years from retirement, you're also in your peak earning years. So, yeah, you feel it when you look at your 401k statement and the market's substantially down. But you're also usually, in those last 10 years of work, you're usually adding more money systematically through your paycheck, payroll deduction into, say, a 401k. You're typically adding more money on a systematic basis than you ever have in your life. And those extra payments, those big contributions, take advantage of the market downturn. And when it comes back, it makes money. Now, as you get closer to retirement, you got to be a little bit more cognizant about some things because you're going to need income in retirement and you're no longer going to be saving money. So you lose that advantage that you have as an investor while you're working, where you invest when markets are down. So as you get closer to retirement, you've got to start thinking about income. And that leads me to my third point here, is time horizon, understanding the importance of time horizon in your investment portfolio. We should invest our money based on when we're going to need that money. And you've heard me talk about that a lot on this show because it is such a fundamental thing, especially when you get closer to retirement, you're going to need to draw from your life savings. See, it becomes very critical to understand that up until your retirement, you're saving and accumulating money, and you're taking advantage of things like market declines. But when you go into retirement, you're now spending that life savings. And where I said you can take advantage of market declines when you're working and contributing to your 401k, the opposite happens when you're retired. Market declines are devastating. When markets go down and you're taking money out, you compound your losses. So it's the opposite. It compounds the problem of market declines when you're drawing income from your life savings. So it's critically important to understand time horizon. And what that means is if I know that I'm going to need income starting a year or two from now for retirement, I don't want the source of that income to be in the stock market. I don't want that to be at risk because I have no idea where the stock market will be in 2 years. I definitely have no idea where it'll be in 3 or 6 months, but I really don't know where it'll be. What if there's a bear market a year from now and my investments are down? I'm going to feel stuck. I might feel like I can't retire because I'm going to have, when I retire, I got to start pulling off that investment. You don't want to pull off of it when it's down. So you got to have money set aside to structure for stability of income in those early years of retirement. And then the money they invested in a very, very diversified portfolio, not just the U.S. stock market, but very diverse with things like, you do need foreign stocks. You do need some bonds. You got to be careful with bonds, in my opinion. But you need other things. When we talk about diversification, we need things that when one thing zigs, another zags. So if one thing's way down like stocks, hopefully they're not all way down. So that would include things like commodities and energy and natural resources and things like that, real estate. You add more diversification, but when you're invested in a diversified market-based portfolio, you have to have time on your side because markets are unpredictable and volatile. So we don't know how we're going to do over a 1 to 2 year period. But if I wait 7 or 8 years before I need to start living on that money, even 5 years would be the minimum in my view. You can go through inevitable ups and downs as long as you don't lose too much. That's where the diversification plays in. And you're really one of your two biggest risks over time, if in retirement, is inflation. The other would be big market decline in the early years of retirement that you haven't planned for and that your portfolio cannot withstand. Now then there's others, medical risks, things like that, but the inflationary risk is such a powerful opponent with people living into their 90s regularly now. And so market-based diversified investment historically has been the number one way to beat inflation over time. But then we inherit the unpredictability in the short term. And so that's where the understanding time horizon, so if you think of it as setting up different buckets of money, that's where that becomes so increasingly important. So we got this parallel economy. We got economic data telling us one thing. We've got consumer sentiment saying we don't believe it. And I think the number one reason is inflation. That can lead to unpredictability and uncertainty. As an investor and or a retiree, how do you navigate that? It's time in the market is what's most important. Be careful you don't, jump on a 5.25% CD because you want the 5.25% guaranteed and you take money out of the market, you might miss out on a rally. Because they have different objectives. A CD is to provide stability and guarantees in a shorter period of time. The market is to provide growth over a longer period of time. That's where the time horizon comes in. And then also understanding when you're saving money, systematic investing, you actually take advantage of market volatility and market declines because while your pot of money is down, you're getting to invest money while the market is down and you're buying lower. And if all the market does is recover and get back to where it was, you're actually in the green. You broke even on the pot you already had, but then you're adding in more investment while the market is down that makes money in the recovery. So very, very important fundamental concepts to understand as we navigate this very, very tricky economy and the economic reality of where we are. Now, when we come back, the soaring debt is becoming a bigger and bigger issue. Policymakers are starting to talk about it more and more. And it's not just the amount of the debt, it's the interest on the debt. And the deficit spending is becoming problematic. So when we come back, how do we need to be thinking about that? What is the reality of where we are? What does that mean for your income taxes in the future? And what can you be doing now to take advantage of that? So stay with us. You're listening to More Living right here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in this week. More Living with Jim Brogan, where it's all about living the best years of your life your way. It's a beautiful, beautiful day, so get out there and enjoy it. We're with you every Saturday from 9 to 10 a.m. and again from 3 to 4 p.m. You can also catch all of our shows podcast on our website, broganfinancial.com. You can click on radio. And you can also go to Spotify, Apple Podcasts, those places. We've been talking about the economic conditions, and I want to pivot a little bit to the federal debt. The national debt has been increasing at an unprecedented rate, and it is raising alarms among economists and policymakers. The magnitude of the debt and its potential impact on the economy. We look at deficit spending. The federal budget deficit has been widening due to increased government spending and lower tax revenues. And the persistent deficit spending is a significant factor that's contributing, of course, to our overall debt burden. Those high levels of debt and deficits at some point you would expect could end up stifling economic growth. Borrowing to finance deficits can lead to a higher interest rates, which in turn can crowd out private investment and slow down economic expansion. And then, of course, there's the inflationary pressures. Increased government borrowing and spending can lead to inflationary pressures. That's one of the reasons, among many, that we're seeing some of the issues we are with inflation. So sustained high inflation can erode purchasing power and destabilize the economy. And then financial markets are sensitive to changes in fiscal policy and debt levels. So the long-term sustainability of the U.S. fiscal position is definitely a concern. And so I've got a few quotes here just to kind of underscore this. Federal Chair Jerome Powell, he recently said in terms of the debt, the Congressional Budget Office estimates that the debt held by the public compared to gross domestic product, which would be the size of our economy, will rise to an amount greater than any point in the nation's history. And Jerome Powell said, quote, "This is something that elected people need to get their arms around sooner rather than later." And he said, we're running big structural deficits, and we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. And when referencing the Congressional Budget Office reports, Jerome Powell said everyone should be reading the things that they're publishing about the U.S. budget deficit and should be very concerned that this is something that elected people need to get their arms around. The CBO estimates that as a share of GDP, the deficit in our budget will grow from 5.6% in the current year to 6.1% in the next 10 years. And the report states that since the Great Depression, deficits have exceeded that level only during and shortly after World War II, the 2007 to 2009 financial crisis, the Great Recession, and the coronavirus pandemic. That's straight out of this Congressional Budget Office's report. In other words, these high deficit levels are common most often in economic downturns to help stimulate things, not in the relative prosperity that the U.S. has enjoyed for most of the era following the brief plunge after the pandemic declaration in March of 2020. We got deficits 5.6%. Then we got Jamie Dimon from J.P. Morgan Chase. And he says the problem, at some point, this will cause a problem in the market. The problem will be caused by the market will kind of force the issue. We're treading around 15% of our federal budget is to pay interest on the debt. And whenever we get that high, we typically see the markets respond negatively and pressures Washington to do something about it. So we're right in that range. So, what does this mean for us? I will go back from an investment perspective. It means you need to stay invested and keep investing if you're working. And if you're retired, you need to create, buckets that based on time horizon when you're going to need money, so you don't have to liquidate market investments and then use that money for income when markets are down because you end up compounding your losses. But I want to talk to you a little bit about our tax situation, and I've talked about this many times over the last couple of years. If we look at, I mentioned World War II. If you look historically at where tax rates have been, the all-time highs we saw were after World War II, when the highest income tax bracket was 94% for federal income tax. It dropped down for an 18-year period from 1946 to 1964. The highest tax bracket was over 80%. In most of those years, it was over 90%. In the 70s, for most of the 70s, the highest income tax bracket was 70%. The first 6 years of the 80s under the Reagan administration, the highest income tax bracket was 50%. Well, ever since 1986, we have been in a world where the highest income tax bracket has been less than 40%. Historically, that's just a lot lower than it's been through most of our country's history, especially since if you go back coming out of World War One. And then you look at the lead up to the Great Depression with the Roaring Twenties, and then we look at where we are now. And when I say the highest brackets, I have a chart that I use in one of my tax planning classes, that shows the history of all the brackets. And they all went up, they've all come down. Something's got to give. Now, I am not saying that the way to solve this issue is to increase income taxes. That's a supply side versus demand side argument. And there's a lot of debate amongst economists of what is the ideal tax rate to stimulate economic growth and be able to pay and not have a huge deficit for our spending. But the bottom line is, we've got a situation that if you look at any industrialized society around the world, when we get in a spot like this, usually the first thing that happens is the government will raise income taxes. And then after that, the second thing the government might do is cut benefits, cut their spending and their benefit grids. So that's usually the order that it happens. So if we look at income taxes today, we had the Tax Cuts and Jobs Act from 2017. So since 2018, the tax rates went down some, and those provisions are mostly going away at the end of next year. So January 1st of 2026, we go back to the rates from 2017 adjusted for inflation. And there's a couple of key things there. One is tax rates go up for most Americans. Most brackets, the 12% goes to 15, the 22 goes to 25, the 24 goes, in some cases, the 24% bracket's going to go to 33%, which is a huge increase for higher earners, up over a couple $100,000 plus. And then, so you've got this issue with where taxes are going, but then where are taxes likely to go in the future? Because the tax rates prior to 2018 were pretty friendly. The highest income tax rate was 39.6%. I know it doesn't feel that way, feel friendly, because every time we turn around, it feels like we're paying some kind of a tax. But if we look at federal income tax revenue solely, the rates have been low since 1986. That's a long time. So I think the likelihood, and we got people like Jerome Powell and Jamie Dimon talking about sounding the alarm of we need to fix this sooner than later, because the longer we wait, the more stress it could put on our system, on the financial system. And so the odds are, in my opinion, that 10 years from now we could see a radically different tax environment, with taxes being consistently higher across the board. Now, we don't know that. We are, in a way, shooting for a moving target, but we know rates are going up the end of next year, and we know that there's a risk. So I think in your financial planning, you've got to hedge a little bit on where we may be 10, 15, 20 years from now. I talk about what I call tax diversification. We think of investment diversification, investing in a lot of things that zig and zag at different times, so they're not all up and down together. But then there's also tax diversification. So here's an example of that. When I put money in my 401k, I get an immediate tax deduction. So that saves me taxes now in my tax rate now. But then I have to take that money out later in life, typically after you retire, after age 59 and a half. Certainly there's exceptions, but you have to take that money out, and then you're taxed at a rate in the future, and you don't know what that rate's going to be. So when you're in your 50s and early 60s and you're in the highest earning years of your life, it makes a lot of sense to do traditional 401k investing, because you're thinking, hey, I'm in a higher tax bracket. But what will your tax bracket truly be like when you're retired, and when you get deeper into retirement, into your mid-70s, and you have to start taking those taxable distributions from your IRAs and 401ks, those required minimum distributions that are taxable? What is the taxable income situation going to look like then? We've got situations right now with people that are retired or getting close to retirement that are in a 22% tax bracket or maybe even a 24% tax bracket. And under the tax code for the end of next year, they know that when they're in their 70s and they have required minimum distributions, even if tax rates do not go up, they're going to be in a 33% tax bracket, or 32% tax bracket. So, but we don't know what's going to happen in the future. So there's some benefit to putting money in a 401k and getting the tax deduction. But there's also a benefit to putting money in a Roth or doing a conversion where you pay the tax now at today's rate, and then later in life you have tax-free money. And now that only works if your tax rate later in life is higher than it is now. That's when the Roth beats the traditional 401k or IRA. But diversification would be saying, I want to take advantage of both of these things because we don't know. We're kind of shooting for a moving target. And then there are some investments that are taxed as you go, right? If you're not in an IRA or 401k or a Roth, you have a traditional investment account, you get 1099s every year on any of the distributions or capital gains, whatever the case may be. You kind of have to pay some of the tax as you go. However, some of that investment, particularly investment with long-term capital gains, where you buy something and you own it for more than 1 year. Long-term gains rates typically are much more attractive than ordinary income. And see, when you take money out of an IRA or 401k, it's ordinary income tax. It's not long-term capital gains. And so long-term gains are definitely preferable. The Internal Revenue Code, which was ultimately written by Congress, gives us investment incentives to invest and have long-term capital gains and be long-term investors. But you need to have investments that can take advantage of long-term capital gains. If all of your investment is in your retirement accounts, you're not going to get that advantage because when you sell it and take it out as a distribution, it's taxed as ordinary income. So you want to have a pot of traditional investment that's not in the IRA or 401k. And unfortunately, most people I meet with and that come to my classes at UT and Pellissippi State, most people, their investments that are outside their IRA and 401k are in things like CDs and treasury bonds and things like that are taxed as ordinary income. They don't have capital investment, stocks, funds. They don't have capital investment that can take advantage of long-term capital gains. So again, that's another lever, if you will, of tax diversification where, hey, you get some tax benefits now with a 401k or an IRA. You get tax benefits later with a Roth, but no benefit now. And investing in a traditional investment account that's taxed as it grows, that gives you the opportunity in the future to take advantage of long-term capital gains rates. So that's tax diversification. We don't know where we might be in 10 or 15 years. We see the data and we see the challenges. And so we want to take advantage of all of these things because we don't know what's going to pay off the most. But what you don't want to do is get stuck where, everything's in an IRA or 401k and everything coming out is ordinary income. But likewise, you don't want to get stuck where everything you've been putting into a Roth and then your income goes way down in retirement and your tax rate's a lot lower, and it'd been better for you to get those tax savings in your working years. So tax diversification is a critical component, in my view, to financial planning. And with today's outlook of deficit spending and federal debt and tax rates, I think we've got to have tax diversification. Now, when we come back, if you're a little further out from retirement, 15, 20, or even 30 years, what's the one biggest trick that you can use to generate exponential wealth? Stay with us. This is More Living here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. We've been speaking about the economy. We've been talking about the deficit spending. We've been talking about tax rates. In this last segment, I want to talk about maybe the single biggest trick, especially if you're a little further out to retirement, 15, 20, 30 years or more. How can you exponentially grow wealth the best? Exponential is defined as growing or increasing very rapidly. And here's a good way to use it in a sentence. Saving and investing early and often is a clear path to creating exponential wealth. Leverage the power of compound interest. Compound interest, Albert Einstein called it the eighth wonder of the world. He also called it the greatest concept of mankind, where you're not just earning interest on your principal, you're also earning money on your earnings. The power lies in the ability to generate returns on your returns, not just the money you contributed, but returns on returns. But in order to do that, it's critical to understand the importance of time and having that on your side. And I think one thing that everybody should understand is the Rule of 72. And what the Rule of 72 does is it tells you with compound earnings, in other words, if you let your money sit there and keep the earnings invested and you start earning money not only on your principal but also on the earnings and it compounds, the Rule of 72 says, how long will it take your money to double without making any contribution or if you don't take money out? And basically, if you take an expected earnings rate and divide it into 72, it tells you how long it'll take the money to double. So if you average 8% per year, your money will double about every 9 years. And it's rough math, it's not exact, but about every 9 years. Well, see, when you first get started and you see $1,000 grow to $2,000 or $2,000 to $4,000, it does not seem that significant. But it becomes very significant the last double that you get prior to retirement. When you go from 500,000 to $1 million or from 2 million to 4 million, well, now that's very, very substantial. Well, see, the earlier you get started, the more of those doubling periods you receive the benefit of. And it's not the first one that's so powerful, it's the last one. But if you get started early, you could add one at the end. Does that make sense? You could add that powerful doubling. Now, if you're closer to retirement, 5 or 10 years, and you're like, well, Jim, I don't have the benefit of 20 or 25 years, you can still compound your wealth efficiently on a bigger nest egg. I mean, hopefully you have a bigger nest egg than you did when you were 35. And so the key is to keep it invested and keep adding to it, and you're probably making more money than you've ever made. Invest more money than you ever have. And as I said earlier in the show, you get to take advantage of market volatility because when the market declines, you're adding in more investment, substantial investment, while it's down. So you can get some of the benefits of the compound interest. It's not available to you, if that makes sense. But starting early, I just cannot tell you, when I speak over for students at UT, either undergrads or MBA students, I always talk about the power, this fundamental benefit of compound interest and creating wealth in the Rule of 72. Because it really is, you get out of college, you get your first job. As soon as you start making money, if you start setting money aside and investing, then that's going to add you another compound at the end of your career. And again, going from $1 million to 2 million is much more powerful than at the beginning when you go from 1,000 to 2,000. So sometimes it's hard to see the light at the end of the tunnel, and I get that, especially early on. But investing early and often, and no matter how close you are to retirement, even if you're closer, the sooner you can start saving and investing early and often, the better off you can become and the more independence and wealth you can create. So thank you so much for tuning in this week. We've discussed your wealth, we've discussed the economy, we've discussed tax rates, because greater wealth provides for more living so you can live the best years of your life your way. Many thanks to Wayne for engineering the show. Many thanks to Jill for helping produce the show. Check us out online, broganfinancial.com. We've got a wealth of information there. You can podcast all of our shows. If you click on radio, we've also got resources. So check us out at broganfinancial.com. You can also click on our class tab and find out the classes will be starting back in August through the University of Tennessee and Pellissippi State. So thank you for tuning with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.